Good morning, ladies and gentlemen. This is Clueless 8. It's pre-market AM report for the week ending Friday, February 19th, 2016. Let me go over a couple of important pointers that people need to monitor on their own screens so that they can effectively manage their own trades and all my suggested recommendation on particular tactical as well as swing trades. After all, this is a business of personal responsibility and not a business of hand-holding or babysitting. So let's get straight into the technicals at this point. We have had a lot happen this week. It's a shortened week. It seems like it was a very, very long week, even though it started kicked off on Tuesday morning. We have had a very powerful run off the markets, off the bottom here, almost a 1,000 plus point run on the Dow, which which uh, uh, which hit the highs on the E-minis at around 1933, as you can see here. We have a very, very tight bottleneck that I've been pointing out for the last couple of days, and you can see that clearly in the form of this bottleneck here, right? Here's the Darvas box. This is a Darvas box bottleneck, okay? So which way the bottleneck resolves is really the billion-dollar question, okay? The way I look at it, and it's just chart reading, and chart reading is not a exact science, just like trading. It's a game of probabilities, not a game of certainties that many traders would like to think. The fact is that the only way you can read these things is try to read the curvature and the shape of the trend lines, the directional bias, mix in it with a couple of internals, which are severely overbought at this point. Put in part of the experience or the gut feeling that we have over years of looking at markets and trading the markets, winning and losing, and of course an element of luck. So when we look at this yellow line here, which is really the short-term trader's friend, which is the 5-day moving average, we can clearly see here that the 5-day moving average is moving up nicely. Unless the 5-day moving average starts to turn down, as we clearly see in all these instances, you don't get a short-term downtrend. You turn down here on the 4th and continue to have that huge cataclysmic waterfall decline that culminated into this double bottom at around the 1800 level. Same thing here. If you notice, the 5-day moving average started to go down. It remained down, and every time the markets came up towards the 5-day moving average, they got rejected. That's a sign of a downtrend, intermediate downtrend move. In the meantime, as the 5-day starts to move down, you start to see a reset on the internals, which go hand in hand. It's pretty simple stuff if you really, use a little bit of your brain and hopefully more of your eyes. Um, so it's all visual stuff going on. So at this point, we don't see that happening. Now, the only way the 5-day moving average is going to start to curl down is if we get another 2 or 3 days of large red candles. You can see that here. You can see that there. Okay. Chart reading here. In the meantime, if you look at pattern symmetry that I explained in excruciating detail yesterday, and I suggest that everyone re-review those video casts that I did yesterday morning and the ones prior to that, I have showed you clearly the pattern symmetry of what's going on between here and back then in August 24th and September 29th. Pattern symmetries work, and like I said, it's not exact science, but they work majority of the time simply because human behavior never changes. We all like to think that we are changed individuals because, we're not going to do that mistake again. But the reality of the situation is we always do. So the best thing we can do is adapt and minimize our bad habits and maximize what is good in us. In other words, our good and effective habits. So try to do that every day, and I think we'll be better human beings and better traders to start with. All right, that's just the way it is. So talking about bad habits, humans always do the bad thing. They get scared, they sell at the bottom, they chase on the way higher. Then we have a corrective consolidation like this, and I put out a chart there with the little caption showing where traders are getting in, and that is the truth. And then they see a little consolidation, they start freaking out. It's the same old story, like I like to say. All right. So it looks like that story is not going to change, and I'm not going to sit here and try to change anyone's behavioral dictums and their cognitive biases on how they manage their life or their trading. Okay. I can only venture forward as I do on so often, um, and try so hard to change the behavioral habits of traders and investors who are within my group here in the closed say trading group. But in many cases, I'm sad to say that I fail because I see the same patterns repeating themselves. But many have conquered their fears and moved on and not repeating the same terrible habits that they were, let's say, a year or a year and a half ago when they started with the service. So saying all that, the technicals are dictating that the 5-day moving average is moving higher. I'm going to watch this very, very closely. And this little consolidation, these two red bars that we're seeing here, futures down about 6 points, and then yesterday being down, is clearly still in a consolidated form. In other words, it's a consolidation flag. That's what happens. All right. Big move, and then you get a consolidation. Now, this consolidation can take the form of a 50% Fibonacci retracement, which would roughly bring us down into that 1870 range. And we're still okay. However, I believe that if we fall below, let's say 1877 or 1865, things start to get quite a bit dicey. In the sense that this is the consolidation channel. I'm not saying this is the exact bottom, but let's say, this is the consolidation channel. So if we fall apart from that, and there is a very good chance we check the lower, the Bollinger here, the lower Bollinger at 1826, and that creates another dragon bullish pattern if the market is still wants to go higher. We break that, then we're going to test the 1800s. In this particular case, in my opinion, we'll slip because this time there will be a full-fledged panic, like, oh my God, nothing works, the world is ending, and that type of doom and gloom, and that will push us into the 1780 range on the S&P 500. If we thump down really hard, couple of 200-point down days, at that point, this 1800 level, which has acted as support, will give away very, over for maybe an hour, maybe 2 hours, maybe for a day. I don't think it's going to be longer than that. And we slip to 1780. So roughly we'll slip about 100 or so points or 120 points below the 1800 level on the Dow. I mean, S&P 1800 level. So that's about, we'll slip. And at that point, it is possible that we create a triple bottom. That should, in my opinion, hold, and the market makes another phenomenal 1,200 point rally, which I'm sad to say many of you will miss because you keep on practicing your terrible habits. Because the key to buying was to selectively buy at these levels, add a little bit more at these levels, and then sell into the euphoria and the gang gang rush or whatever you call it, right? Not chase the market at these levels when I'm telling people, look, we are overbought, we are due for a pullback. Got to be selective, ladies and gentlemen. You have to be selective. You have to be somewhat smart, or just common sense. So you don't buy here. You don't buy here. I know it was a long weekend and a lot of the futures were up during the weekend. You don't buy, you don't necessarily need to buy here into the last minute rush, and then you get this consolidation triangle and you're all freaking out. If I didn't care about my members and my subscribers and I really felt like these things needed to be told, I wouldn't be doing this video cast right now. I'm just telling you that right now, okay? I do stupid things too. I should have been far aggressively long at this bottom than being moderately long. But there were huge winners along the way. The price lines of the world, the fossils of the world, monsters, and many others during the day. And one key thing about earnings that I want to warn everybody, you're going to play earnings, it's a 50-50 toss-up. So you play it with small common, play it with small options, and that's it. End of story. Because earnings are not gameable. A stock can be down 6, 7, 8% after earnings, and then you look at it a week later and it's up 10%. Because there are certain earnings which are kitchens, they throw out the kitchen sink, or what do they call it? The kitchen sink quarters. In other words, they just throw all the bad news out at one go. And the stock creates a tradable bottom. And that happens a lot. Don't think this is a binary effect that earnings are going to be good and stocks are just going to go higher. It doesn't always work like that. Sometimes it takes a little bit of a twisty route. Okay? Comes down first and moves higher. That's where you got to look at your own chart. You got to figure it out. So that's a big warning about earnings, I'm telling you. There have been very seldom earnings which have one way down and then continues to go down. If it's a real company, I try to select good companies which I think have potential. There are hundreds of companies that are reporting earnings. I don't go out there and put 50 or 100 of them. I try to select the ones which, in my good faith and judgment, can possibly do well. And overall, my earnings calls have been very powerful majority of the time. End of story about earnings. So the point is that here we have a consolidation flag. We break really hard, let's say below 1887. I think we come down very quickly. In the meantime, the daily is showing us large overbought conditions. This is on the E-minis, which are the most transparent of the moves. But then at the same time, look to see what's happening here on the hourly. The hourly is starting to get oversold. We're not fully there yet. It looks like we were there at 6 this morning. Right there, you can see that. And now we're starting to move up. Today is options expiration monthly, which generally has a bullish bias. We'll see what happens. Futures are down 6.25 right now. Oil is down 64 cents. I pleaded with people, or I should pleaded. I showed and I suggested the DWTI trade with the setup that I do. And one of our good members, Corey, as I was talking to him later in the day, he said that was amazing how I did that. I've shown that for many, many days, by the way. And I'm not going to keep on showing it because it's up to people to set it up that way. But he was very impressed with the way because he's trying out his hand at DWTI, which is great because everyone should try their hands out at new things. That's the way how life works. The biotech ETF LABD, LAB as in boy, D as in Tom, is also another good one to hedge against biotech pullbacks, which we certainly get quite often. That thing was up 11% yesterday. So you got the oil inverse ETF, you got the LABD inverse ETF, you have the VIX UVXY. There are enough instruments out there, and there's a slew of other ones out there that you'd like to play. So the oil thing, for example, to be honest with you, there's the setup, right? There's the setup. It's not rocket science here. So here is where I recommended buying, around the 230 levels in this zone. It's at 278. If I gave you a stock at 230 yesterday, that's at 270. I don't know what to say. I deliver way too much good content out there. I'll tell you that right now. It's up to you to take advantage of what's out there and make your own decisions what you need to do. But this is serious stuff. I'm not going to push anyone into anything. It's your adults. You do what you need to do. So look at this. Want to magnify it? The pain of sacrifice is far less than the pain of regret. So if you sacrifice a bit of those demons in your head and bought a little, bought one share, okay, hypothetically speaking, as a symbolic gesture, at $230, it's 270. Bought 10, bought it 100. I don't want to, go overboard and buy thousands of shares. You don't do that. You buy it in moderate amount depending on your risk tolerance because this thing does zigzag and move. It'll be down $5 in 1 second because oil moved up. Here's oil. Because oil moved up 5 cents. I looked at oil. I said, look, it looks like a short-term top. And at this point in time, looking at forget the daily. The daily doesn't tell me anything. Looking at this thing here, which I showed clearly, and I don't want to keep on repeating myself. I posted this during a busy trading day, and it looks like oil wants to go to 31 and test the downtrend line. It's not the end of the world, and it might not even come to 31. But technically speaking, yes, the downtrend line retest solidifies that this was the downtrend line. So 30, 89, 31. This goes to 31. I had big arrows showing that. I don't know how much easier I can show these things. That if it does go to 31, this thing is going to go to 300 real fast. And that's the WTI. Going back to what we were talking about, I'm going to show you the S&P actually on this one. This is the S&P 500 on the 1-hour chart. Okay, the white channel. Then there is another intermediate channel that's in this one, right? White lines, easy to read. This is where we are. It's not the end of the world if we come down and test 1894. That's roughly 21 points Yeah, that's 21 point. That's roughly another 100.